China is the world's second largest economy, the second largest supplier of products to the United States, and the second largest foreign holder of U.S. debt.
So China is actually a bigger financial power than it looks like on the surface.
President Trump is using tariffs to address China's dominance. The White House has suggested that tariffs on some Chinese products may reach up to 245%. In January 2025, the average U.S. tariff rate on Chinese exports was about 20%. By the end of April, this rate shot up to about 124%, which means the cost for U.S. companies importing goods from China has more than doubled for now.
We've already raised tariffs to such a high degree that with time, trade will go to zero.
It is a very uncertain period of time, so a lot of businesses are having difficulty planning around that changing landscape.
The fact is that both sides need the other.
The escalation this spring made markets panic. Trump is now ready to negotiate.
I'm not going to say, I'm going to play hardball with China. I'm going to play hardball with you, President Xi. No. We're going to be very nice.
In May, the Chinese government indicated that it's evaluating the possibility of trade talks with the United States.
China is sending strong signals that the games that we are playing, which are tariff games and supply chain games, for them it's about survival.
Here are some of the ways that China could retaliate against U.S. tariffs. The U.S. government is over $36 trillion in debt. China is one of many foreign countries holding that debt. The U.S. borrows money and goes into debt by issuing Treasury securities. Entities in China have been buying these securities for decades. These holdings give China some influence over U.S. financial markets.
All told, China's holdings are now 4% of GDP, of our GDP. That's big enough that if they sold it really, really quickly, and if the Federal Reserve just did nothing, that it would have a short-term impact.
But the Fed doesn't always intervene. People who need to finance homes could feel the impact. In April, as news of tariffs spread, yields on 30-year and 10-year Treasury bonds increased. Rates for consumer loans, like mortgages, shot up alongside them.
In theory, if China wanted to try to tank the bond market, what it would do would be to take all of the treasuries that it owns and dump them on the open market at once. And in previous financial crises, particularly in 2008 and in 2020, when there's been such a crisis, there is often what is referred to as a flight to quality. So a lot of folks feeling suddenly very risk averse try to invest them in the safest asset, which is in fact US Treasuries. The weird thing is that didn't happen. And that prompted a whole bunch of speculation that maybe either China or Japan were dumping bonds.
But experts do not believe that China has played this card, at least not yet.
I think what we saw recently had very little to do with China and more to do with others who are really questioning the good faith of owning U.S. debt these days. For China, though, the signal is Trump is paying attention to the bond market. Quite frankly, it's great for China. They may not even have to fire that gun because when others fire it, people assume that it's China or think that China may fire it and then further imperil the U.S. situation.
That said, China's government has other tools it could use against the U.S. For example, China supplies 60% of the world's rare earth elements. These elements are crucial for modern technologies in defense, alongside oil refining, electric cars, and wind turbines.
We're starting to see some export controls put in place around things like gallium, germanium, antimony. And the Chinese have a long list. Lithium is another. And here's where the U.S. is extremely vulnerable because we still rely a lot on China's supply chain for some of the elements that we need in our defense sector.
And this is a case where finding a substitute for those critical minerals is going to be extremely costly.
The higher tariff rates on China slowed activity at U.S. ports down sharply. There are now concerns that a supply shock is inbound for the U.S.
Some businesses are saying we're going to hold off as long as we can, and they're paying higher storage costs. Our other clients are trying to move to third countries, right? They're determining, while there may be a global tariff on countries in Europe, on other countries in Southeast Asia, or more broadly, they're wagering that those tariff situations are going to be more favorable than China.
Products imported from China tend to be cheaper than those made in the U.S.
The Chinese business model is predicated on selling subsidized goods into the U.S., so I am sure that they will come and want to de-escalate.
The U.S. Treasury Secretary, a member of Trump's cabinet, has argued that the American dream is not about access to cheap goods.
Contrary to what the Secretary of the Treasury said, Americans are actually pretty happy with having cheap goods. And so as a result, we buy a lot of them, and therefore we've been running this persistent trade deficit for a while.
China's trade surplus remains sizable, despite shrinking since tariff rates first rose in 2018.
A lot of companies benefited from it. Most consumers benefited from it. I mean, Apple would not be as profitable if it wasn't able to make all its iPhones in China. And I would throw in, like, look, a lot of the winners on the corporate side have resisted, frankly, contributing to our society in ways that would make it easier for us to help those who've been left behind.
China was the third largest destination for U.S. exports in 2024. From China's perspective, imports from the United States are big business, but it has other options.
China basically told its state-owned oil and gas companies, you're not going to buy any U.S. natural gas. And we got news that China had told its state airlines that they can't take delivery of Boeings that they've already ordered. If China really wanted to play nasty, they could say, we're going to limit exports of iPhones. You could squeeze Tesla, both limiting its sales in China, but also making it much, much, much harder for Tesla to get parts and kind of squeeze their Chinese operations. You can do that for other companies too. So China has a lot of levers.
As well, we saw additions in China of what they call the unreliable list. Basically, a list of entities in China that have a lot of difficulty doing business there when they are added to that list. There are restrictions on investment, on import and export activity. So it's their equivalent of a blacklist of U.S. companies. So I'd say energy and agriculture are probably the two most impacted industries on the export side of the house.
So the agricultural sector, particularly agriculture in red states, will find themselves at some point, the longer this goes on a list. So soybeans, of course, was the big one in 2018. We're likely to see a revisit of that. And here, it's particularly painful because since the first trade war, many of our soybean farmers have spent so much time trying to rebuild their relationships in China, bring back some of the market share that they lost to countries like Brazil, and it's likely going to be hit again.
The countries that face higher tariff rates have tight deadlines to negotiate with Trump's team. That's straining political relationships that were built over decades.
One thing that would give me pause is if you saw a much stronger relationship form between the European Union and China in response to the Trump administration's trade policies. The Trump administration has burned through an awful lot of goodwill in the international system. The reason the dollar persists as the global reserve currency is, at this point, is not because of any real, fondness or American soft power. It's because of just the weight of history.
Even 3 months ago, before the reciprocal tariffs, I think a lot of countries in the world would have been on the side of the United States. China has been a very difficult trading partner. There was, and I think there still is, a real concern that trading with China just means letting your own industry get wiped out.
China's President Xi Jinping visited Vietnam, Cambodia, and Malaysia in the weeks after worldwide reciprocal tariffs were announced. He called for joint efforts to push back against, quote, unilateral bullying from the United States. China also promised to retaliate against any nations that cut deals with the U.S. to the detriment of China. China's position in the world grew when the United States lobbied for China's entry into the World Trade Organization in the early 2000s.
With hindsight, I would not support China's entry into the WTO. I think it's ended up causing more problems than it has solved.
China has sent out loads of inexpensive products over the years, enabled by low wages, fewer safety standards for workers, and looser environmental regulations, hollowing out the manufacturing base in countries like the United States. Some see Trump's move on tariffs as long overdue.
There are many of our clients who are very supportive of higher tariffs. These are, largely domestic manufacturers or producers that have felt for a long time like their products are unfairly competing against foreign imports.
Time will tell if the plan works out.
Given how the U.S. government, particularly CBP, Customs and Border Protection, who's on the front lines trying to administer this. Do you have the manpower capabilities to do this effectively? My answer to that is I do not believe that we do. If we do continue to go longer in this trade war, we're going to see greater and greater challenges, more chaos at ports, slow entry times. You have to always ask yourself, can it be achieved with the current set of resources and manpower?